Okay. So the last point is information support system should be there. Information should be abundantly available. Transparency and ethical procedures should be there in the company. Okay. So these are the 6 principles of beyond budgeting. First principle is that clear boundaries, clear organizational structure, clear rules and responsibilities should be established. Relative success should be identified, not just absolute success. High degree of freedom should be given to the management to take decisions. Frontline teams should be established to take responsibility when things go wrong. Relationships should be established both internal to the organization, external to the organization. Internal within the employees, external with the suppliers and the customers. Proper relationships should be established. And then information systems should be there. Transparency and ethical standards should be adopted. Now, what are the benefits, sir? You get faster response time. Innovation will be more, sir, because you are giving better freedom. No, they'll come up with new ideas. Better innovation should be there. And then lower cost will be there because you are going to adopt lean systems. Cost will automatically decrease. And then since you are establishing relationships, customer and supplier loyalties will increase. All that advantages will be there. Okay. So with that, we'll wind up this chapter, beyond budgeting and budgeting chapter as well. Sir, I told you very easy chapter. So we are done with that. Any doubts in this concept, ma? Quickly, any doubts in the concept? 1 minute if there is in the previous discussion, now we would have completed the chapter there itself. We would have started with new chapter. No problem. No doubts. Okay. So shall we start with variances, or do you want me to start with performance measurement now? Chapter 12 or chapter 13? Do you want me to keep variances for the last, or do you want me to do it now? Anyways, tomorrow, day after tomorrow are the 2 days only. So do you want me to do it today and tomorrow, or tomorrow and day after tomorrow? That's the only. 12 variances. Okay. I want opinion, people. Come on. Okay, so everybody are saying variances we'll do later. So we'll start with chapter number 13, that is performance measurement and control. Okay, point number 1, sir. If any of you are planning to do APM, this chapter is going to be exactly copy pasted in APM. Chapter 13, 14, 15. All the 3 chapters are copy pasted in APM. And there you have much more value added to their discussions. You talk about CSFs, you talk about KPIs, you talk about benchmarkings, you talk about balanced scorecard, building block models, performance pyramids. Then you will talk about BCG matrix, SWOT analysis. There are lots of analysis done at APM level. Here, very, very basic level of introductory aspects to the performance measurement and control are given to you. Okay, very basic level of discussion is done in PM level relating to these 3 chapters, chapter 13, 14 and 15. Okay, so chapter number 13, performance measurement and control. Chapter number 14, divisional performance measurement and transfer pricing. Chapter number 15 talks about not for profit organizations. How do we evaluate their performance? So there we'll talk about the 3 is economy, efficiency and effectiveness of an organization's objectives and their activities. And then we are also gonna talk about league tables. League tables will be covered in not-for-profit organizations. Okay, cool. And then coming to divisional performance measurement, we are going to talk about ROI and RI. I don't think it's covered in PM level much, not exhaustively. It's not covered ROI versus RI, but at APM we'll talk about that. And then the transfer pricing, we are going to talk about different types of transfer prices with surplus capacity, without surplus capacity, and all that stuff. Within the organization, at what price should we transfer the price commodities within our organization, at what price? Okay, internal transfers, that's transfer price. And performance measurement and control, this is the most important chapter according to me. You know, your entire paper, PM, performance management, it's not costing. Please understand, it's not costing, it's performance management. How well an organization is performing. So that is what we are gonna discuss at performance management. We are not interested in cost calculation per unit, activity based costing, or else absorption costing. No, that's just introduction to performance management. Without that base, you cannot start these topics. That's why we start with that. That's all. But actually, our prime motive of discussion is to understand how an organization is performing in the market. Okay, and that performance can be measured using different techniques. I can measure a performance using quantitative factors, sales growth, revenue growth, sales growth or revenue growth, profit after taxes growth, net profit ratios, GP ratios, MP ratios, EPS, earning per share capabilities of the company. There are lots of things that I can calculate, EBIT, PBT, or else I can go with DPS, value per share, market value to book value ratio. Hundreds of ratios are there which can be used for evaluating the performance of a company. Quantitative factors. Then there are qualitative factors to be considered. Relationships with suppliers, relationships with employees, okay, or else internal idea generations. How many new ideas are we coming up with? How much growth of sales is coming due to new products that are launched, new innovation techniques that are adopted. Or else we can talk about different qualitative factors as well. Okay, so that is what we are going to discuss in this particular chapter number 13, that is performance measurement and control. Sure, let's start with that. I just gave you an introduction of that chapter. This is one of my most lovely chapters, one of my most interesting and like chapters, the chapters that I like a lot. Okay, so chapter 13, performance measurement and control. So here, what are we going to talk about, sir? First, we are going to talk about financial performance indicators. So financial performance indicators are basically all your ratios, GP ratio, MP ratio, PBIT ratio, ROCE, ROI, all those ratios, profitability ratios. Then liquidity ratios, we are going to talk about working capital ratio, current ratio, PIK ratio, cash ratio. Then we are going to talk about leverage and risk factors like EBIT coverage times, interest coverage ratio, then your dividend coverage ratios, then your debt equity ratios, all that risk related ratios we are going to talk, leverage ratios. 3 different types of categories of ratios will be there. We'll talk about all of those things very quickly. I'm not interested in going in depth and analyzing each and every single ratio here. Then we are going to talk about non-financial performance factors. Non-financial performance indicators are qualitative factors, not quantitative. But the problem with NFPs is that you cannot measure them. Sir, how do you measure customer satisfaction? How do you measure employee satisfaction? How do you measure relationships with suppliers? We cannot measure these things in numeric terms, but we'll try to establish some KPIs for that. We'll talk about that in a moment. Analyze the past performance and suggesting the ways to improve the financial and non-financial. How do we improve ourselves? Explain the cause and problems caused by short-term nature versus long-term, short-term goals versus long-term goal, financial manipulations and all that stuff. Balanced scorecard, building block model, and then there is performance pyramid is not given. That is also there. I don't think they have covered it here, but performance pyramid is also there. Kaplan's balanced scorecard, Fisher and Moore's building block model, all this stuff. Qualitative areas, how is it difficult to set some targets? That is also the next topic. Very nice and interesting topic. We have 30 minutes, so let's go. So first of all, sir, coming to the financial factors, financial ratio analysis. This is the most dumbest area, ma. So just you need to calculate the ratios and then identify the reasons for that. See, there are 3 different types of financial factors, ma. Let me take you through it very quickly. Okay, so financial performance measurement. We have 2 types of performance measurement. One is financial and the other one is non-financial. So in financial, we have 2 techniques again. What are the 2 techniques, sir? One is variance analysis, which we should have covered in chapter number 12. And then the other one is your ratio analysis. Okay. So under variance analysis, we will calculate budget versus actual. And then we'll evaluate the performance. Budget was 10,000, actually is 8,000. He underperformed by 2,000, 20%. What are the reasons? So that analysis, performance measurement using the variances. Under ratio analysis, we are going to talk about 3 different types of ratios. What are the 3 different types of ratios? I think I'll make it more exhaustive here itself. So if I'm talking about ratios, I'm going to talk about 3 different types of ratios. What are the 3 different types of ratios? So the first type of ratio is profitability ratios. Second type is liquidity. And third type of ratios are risk and leverage ratios. Okay. First, before I start this discussion, I want you guys to confirm how many of you know all the ratios already done in FR or any other paper. Okay. So since all of you have already done this particular topic, you can unraise your hand, Maswarna. Okay. So since all of you have already done these ratios in FR paper, I'm gonna very quickly just recap the ratios. I'm not going to explain each and every ratio in detail. I'm just gonna give you the ratio as a revision. Okay, cool. This is the only topic that I'm doing as a revision, ma. If any of you need this ratio analysis, please contact me individually. I don't think any of you need this, so no problem. So coming to the profitability ratios, first we talk about GP ratio. So GP is calculated as gross profit by sales into 100. Sir, sales, please consider taking net sales and not gross sales, ma. Sales we have to take after returns. When we are talking about a sales ratio, any ratio where we use sales, we have to take after returns, ma, net sales, okay, and discounts. Next one, NP ratio, net profit by sales into 100. Then we have something called PBIT ratio, or else operating margin, operating profit margin, whatever you want to call it, that is PBIT by sales, profit before interest and tax by sales. Then you have ROCE, return on capital employed. Capital employed includes both short-term capital, it includes both debt capital and equity capital, long-term debt and equity. So that is PBIT by long-term debt plus equity. Please be very careful, not short-term debt. That means current liabilities will not be considered. Only non-current liabilities plus equity should be taken. Or else total assets minus current liabilities should be taken. Whatever you are doing, it's fine. ROCE is PBIT by long-term debt plus equity. Then you have something called return on investment. Sir, capital is employed in the entire business. Investment is made in a certain project. If I'm talking about one business unit, one particular project, it is called ROI, return on investment. If I'm talking about entire business, it's called ROCE, return on capital employed. So return on investment is calculated as PAT from that project, whatever project you are calculating, profit after tax from that project by investment in that particular project. How much you are investing in that capital employed for that particular project. Then you have EPS, PAT by number of shares, profit after tax divided by number of shares, weighted average number of shares. Again, IAS 33 is there. You have a separate chapter in financial reporting, IAS 33 earnings per share, where you talk about basic earnings per share with dilutions. So then you will talk about right shares, bonus shares, then convertibles, all that stuff you will discuss about, diluted EPS and all that stuff. Chalo. Then you have DPS, dividend per share, dividend divided by number of shares. Total dividend, again not. Okay, so these are all different types of profitability ratios. Okay, then coming to the liquidity factors, you have first of all working capital. How do we calculate working cap? Current assets minus current liabilities. Okay, current ratio, current assets by current liabilities. Ideally it used to be 2, now it is changed to 1.5. A current ratio of more than 1.5 is considered to be an appropriate. Okay. Next one, you have quick ratio. So under current ratio, you take both all the current assets, but under quick ratio, you will deduct current assets minus inventory minus prepaid expenses. Current minus inventory minus prepaid by current liabilities. This gives you quick ratio, because inventory and prepaid expenses are not quick enough to be converted into cash. And then cash ratio will be there. So under cash ratio, we will only consider cash plus cash equivalents like bonds, which can be easily redeemed in the market and all that stuff. Equitable security, marketable securities by current liabilities. Okay. And then we have inventory days. Inventory days is calculated as average inventory. If average inventory is not available, closing inventory you take by cost of goods sold. into 365. This will give me inventory days. If I'm talking about payable days, average payables by purchases we have to take. If purchases are not available, we'll go with cost of goods sold into 365. Credit purchases, normal purchases, cost of goods sold in that particular order. Receivable days, average receivables by sales into 365. Correct? Credit sales I'll have to take. If credit sales are not available, I'll take the total sales mark. Okay. So those are your liquidity related ratios. And then coming to the risk and leverage ratios, you have debt equity first of all. That is your financial leverage ratio. Sorry, not financial leverage ratio. That's a different part. I'll not confuse you guys. So we'll call it, there's no such terminology for that. Debt by equity ratio you have, debt equity ratio. And then you have debt by debt plus equity. Then coverage ratios you have. Interest coverage. How many times can you cover your interest? That is PBIT by interest. Sir, you have a profit before interest and tax of 10,000 and you need to pay 1,000 interest out of that. That means you can cover your interest by 10 times. That is interest coverage ratio. Okay. And then you have, oh, I did not write the name of the ratio there. Interest coverage ratio. And then we have dividend coverage ratio. So dividend coverage is profit after tax divided by dividend. Okay. Or the same can be calculated as EPS by DPS. Okay. It's the same thing, but dividing both by number of shares. Numerator and denominator, if you divide it by number of shares, PAT by number of shares is EPS, dividend by number of shares is DPS. So you can calculate using EPS by DPS also, coverage ratio, dividend coverage ratio. Okay. So that's your different types of ratios for your financial analysis. Any doubts? Anybody want me to explain any particular type of ratio in detail? Okay. Nobody wants any particular ratio to be explained. So cool. Let's go further then. No? Good. Okay. So we have ROCE, asset turnover ratios, quick ratio, current ratio, receivable days, payable days, then risk related gearing, debt equity, debt by debt plus equity, interest coverage, PBIT by finance cost, dividend coverage, net profit by dividend, or else PBT, EPS by DPS, or else PAT by dividend, whatever technique you are using. Okay, the problems with financial performance measures, sir. Why we should not use financial performance measures as the only factor for measurement. It should be used. I'm not telling it should not be used, but you should not use them as an individual factor. Only don't depend on the financial factors. Why, sir? Because point number one, they are very short term in nature. Current year PAT, suppose current year I got a net profit ratio of 20%. Does that mean for the next 5 years I'll maintain the same ratio of 20%? No, sir. It's very short term in nature. That is the first problem with financial. Then manipulation of results is very easy. Very easy to manipulate the results. Sir, last day I did some sales and then asked my customer to return it back after 2-3 days. I'm closing my financial year on 31st December. I called one of my very close friend and I told him, come and purchase some commodity, some goods from us. He came, he purchased. Next day I called him and told him that, okay, financial year closed, books are closed, sales are inflated, now come and return it back. Sales returns I'll record. So I manipulated my entire sales over there. I can do the same with payables, receivables, every single figure, changing method of depreciation, changing provisions, all that stuff I can do to manipulate the results. It do not convey the complete picture. It only gives you what happened. It does not give you complete picture. And neither it is an indicator of future. It is historic in nature. Okay, we talk about something that is already done. We are not talking about the future aspects of that. Those are the disadvantages of following the financial performance indicators as the only performance measurement tool. So you should always consider including non-financial factors as well. So now what are these non-financial performances, sir? These are long-term sustainable growth related indicators. Customer satisfaction, employee satisfaction, your growth prospects, your research and development, your corporate quality or corporate nature or corporate culture of your organization. All of these come under the non-financial performance indicator. These are more important than financial factors. Okay. See, having wide range of products, research and development, having a good strong name, goodwill, low prices, cost efficiency, quick delivery, process efficiency, customer satisfaction, high quality maintenance, all of these stuff are covered under the non-financial performance. So look at this airport. They are just giving you an example of a British airport authority. So cleanliness of the facilities that are there, helpfulness of the staff, how helpful they are to the passengers, ease of finding the way around the airport. These are all qualitative factors for identifying the performance of that particular airport. Okay. So this question is a very lengthy question. Never expect these kind of questions for PM paper, ma. They don't really give you this lengthy information. I don't know why they gave it in Kaplan. And again, the same question is repeated in APM also. I think they took this question from APM to PM, not PM to APM. Usually they do it the other way, but I guess this question is done in the reverse manner. Anyways, so see what they are trying to give you in this particular question is total client inquiries. How many of them are new business? Budgeted 50,000, actual 80,000. Repeat business, budgeted 30,000 queries. We expected 30,000 budgeted inquiries will come, but only 20,000 came. Client consultation, budgeted 15,000, but actually we got 20 new business consultation. Repeated, we thought 12, but we did only 10. So we can figure out from here itself that repeat customers are not coming to our organization. We budgeted 12,000 repeat business, but we got only 10,000, sir. That means customer satisfaction is not up to the mark. I can identify from that itself. Okay. There's a lot of information. I'm not going to do this question at all. There's no chance I'm going to do this. I don't do that in regular classes only, let alone revision session. Okay. Now that we understood what is non-financial performance indicator. Okay. Before I move on to the topic, let me just show you guys something. We just did financial performance indicators and we moved on to non-financial performance indicators, right? Okay. I'm going to APM. So look at this. In APM, I'm talking about APM paper, financial performance measures is covered in how many? 6 or 8, 18 to 26. 8 videos, 8 lectures are there. You can see 35 minutes, 25 minutes, 12, 13, 32, 15, 21, 13, almost all 3 hours, approximately more than 3 hours, I guess, 3 and or whatever it is. We have 8 lectures on financial performance. Then again, non-financial performance, another 7 lectures. Look at this. This is 1 hour. This is 1 hour. This is 45 minutes, 15 minutes, 15 minutes. So almost all 5 to 6 hours of lectures only on the financial and non-financial performance. And then not for profit, again, another 1 hour, 1.5 hour, approximately 1 hour, 15 minutes or something like that. Okay. So please understand what I'm trying to tell you here is that we are covering so much in APM, but at PM level, only the introduction concepts are covered for you. Lucky guys you are. Okay. Chalo. Now talking about the balanced scorecard. So this is one tool which is used for the non-financial performance indication. Okay. So coming to the non-financial factors, there are 3 tools which we use. 3 tools. Okay. What are the 3 tools that we use, sir? The first tool is called Kaplan's Balance Scorecard. Then you have Fitzgerald and Moon's building block model. Then you have performance pyramid. I guess I cover building block as a separate lecture, balanced scorecard as a separate lecture, if I'm not wrong. Yes. See, look at this. Balanced scorecard, just a balanced scorecard lecture is for 67 minutes. 1 hour, 10 minutes, approximately 1 hour, 6 minutes, 1 hour, 7 minutes, whatever it is. More than 1 hour only on balanced scorecard. Okay. You can assume how much in detail we'll go in the regular lecture, but I'm not here to talk about that. So we'll very quickly go through the balanced scorecard model. So what exactly is this all about, sir? As I told you, it's a non-financial measure, but it not just uses non-financial. If it is only non-financial, we cannot call it as balanced scorecard. There is a balance between financial and non-financial information here. Okay. So what exactly is this balanced scorecard, sir? It evaluates any performance using 4 methods, 4 criteria. What are those 4 criteria, sir? The first one is customer satisfaction. How many new customers are coming to your organization? How much retention ratio you are having? Out of old customers, how much percentage are you able to retain? How much repeat customers are there? Customer satisfaction, non-financial factor. Okay, sir. Agreed, sir. Next, internal factors, employee satisfaction, whether we are able to achieve our financial targets or not. Not financial, but employee satisfaction, process accuracies, efficiency levels, effectiveness levels, all that stuff internally, whether we are doing better or not. Then third one is your innovation and learning. Innovation and learning means how much research and development expenditure is spent, how many new products are launched. Out of the new products launched, what is the additional revenue generated for the company? All this future value generation is covered under innovation and learning. Then the fourth one is your financial factors, which are ratio analysis, ROCE, ROI, PAT, EPS, all those ratios. So balanced scorecard talks about 4 perspectives: financial, customer satisfaction, then innovation and learning, then your internal processes. All these 4 factors together we are covering in one methodology that is called balanced scorecard. See, look at this. They are giving you customer perspective. From customer's perspective, the goal is to increase the number of new and returning customers, reduce the percentage of customer complaints, customer satisfaction. If customers are satisfied, number of complaints will automatically come down. Then internal process, the time taken has to be reduced. Customer order time and customer delivery time, order versus delivery, the buffer time or the cooking time has to be reduced. That is internal efficiency. Reduce staff turnover. That means employees should not leave out your organization. That is also an internal factor, employee satisfaction. Innovation and learning. Increase the revenue from the new dishes, new products. Increase percentage of time spent on the staff training. So staff training is research and development only. Na? The more and more you train your staff, the future proof they'll become. Financial. Increase the expenditure per customer. Sir, advertisement, marketing, etc., etc. Increase gross profit margin. So these are all different types of financial, non-financial factors. Okay. They have given you the values here. You are supposed to understand. You are supposed to analyze these values and then calculate and tell them whether you are able to achieve it or not. See, for example, total customers are there. In 2018, you had 4,400 new customers. In 2019, you had 4,750 new customers. Calculate as a percentage of the total customers. Percentage of new customers out of total, percentage of old customers out of total. You calculate that and then you check whether the percentage is improving or decreasing. If it is improving, then the number of new and returning clients are increasing or not, you can answer. The first goal is answered. Then percentage complaints. Number of customer complaints, if you see, last year we got 462, current year we got 840. Sir, but this is again has to be calculated as a percentage. Sir, why? Because last year we had 11,600, current year we had 12,000. So you have to express as a percentage and then tell whether the percentage of customer complaints are increasing or decreasing. Okay, similarly, time taken. Last year we took 4 minutes, current year we took 13 minutes. God bless our soul. So you have to talk about each one of these factors like that. Another example is given for balanced scorecard. Now, this is very important for you to understand balanced scorecard. What are the benefits of balanced scorecard, sir? First benefit, it focuses both on the financial and non-financial factors. First advantage, it talks about short-term and long-term goals. It talks about internal information and external information. It covers a wide variety of aspects. That is the first benefit. Those are the benefits of balanced scorecard. Problems is that how do I select the measure within financial factors? Should I take EPS, sales, ROCE, PAT, PBIT? Which one should I consider? If I'm talking about customer satisfaction, number of complaints should I take or number of repeat customers should I take? Okay, all different ratios can be taken, different measures can be used. That is the problem with balanced scorecard. And the second thing is you need so much of information, internal, external, customer relationship related information. internal development, research and development, all different types of information we need. So it's very time consuming to get the information. And the most important is that there is always a conflict between the measures. Okay. So if I'm spending too much amount on research and development and staff training, profits will come down, financial ratios will be affected. Yes or no? Common sense now. If I'm looking for customer satisfaction and thereby spending too much amount, then the cost of production will increase. So there are lots of problems associated with this. If I'm, see, in this particular question, this question actually addresses that issue. See, we are saying that the waiting time has increased from 4 minutes to 13 minutes. But why? Why did it increase? Look at the revenue from new dishes. So revenue from new dishes, sorry, not existing, new dishes. See, last year it was 22,000. Current year it became 40,000, almost all close to double. That means we are, what do you call it? We are adding new dishes, and new dishes obviously will take more time than the old dishes, basically. So because our chefs are new, because they are not experienced, so they are going to take a little bit more time. And also look at the staff turnover. Staff turnover has increased from 12% to 40%. 40% of your employees left the company. That means new people have come in, so they are taking more time to start their activities. They are still in the learning process. So you should be in a position where you are able to link these values. Just saying that meal order time and waiting time has increased from 4 to 13, you will get what? Half mark. But the moment you say, okay, the order time and receiving time, the gap, the time between order and the customer receiving the meal has increased from 4 to 13, which is bad for the company, but we can understand from the staff turnover ratio, which has increased from 12% to 40%, that the existing employees or the existing chefs or the cooks have left the company and the new people has walked in, which is why it is taking more time for them to prepare the dishes. First point. Second point, we can also observe from the revenue from the new dishes that it has increased from 22,000 to 39,600, which shows that the revenue from the new dishes is almost all double during the current period. Again, that could be a reason. The new dishes, the preparation of new dishes might have taken more time, and that could be a potential reason for the increase in the waiting time. If you are able to say like that, no examiner will be in a position to deduct any marks from your exam. They'll be like, acha, 4 marks, extra dark, I'll give them 5 marks for this. They should be like that if you are able to link the ratios. Okay. Time increase, and that's why customer consumers. Oh, okay, very good. That also can be taken now. Since time is increasing, customer complaints has doubled almost all from 460 to 840 because you are taking too much time. So you should be able to link these numbers. You will be able to do that only when you have a comprehensive idea about the entire company's situation. Apsara, extra dark, extra marks. You should get that. Okay. So that brings us to the end of balanced scorecard. So tomorrow we'll start with building block model and then performance pyramid. I don't know why performance pyramid is not given. Only external considerations. Performance pyramid is not there for you. Oh, nice. So performance pyramid only APM. Who is singing that songs, ma? It was there, na? Previously, I remember performance pyramid being there in PM. I remember teaching that in PM. I told you, it's been 2-3 years since I taught PM last time, full batch. So yeah, cool. Performance pyramid has been removed from your syllabus now. Now you have only building block and balanced scorecard. Lucky guys. So tomorrow we'll do building block, the 3 blocks, that is dimensions, standards, and rewards. And then once that's done, then we'll have what? External considerations. So we'll do the external considerations now. We still have 4.5 minutes. So we'll do external considerations. Chiller topic. Okay. Then we'll have only the balanced building block model for tomorrow. So what is this external considerations, sir? See, when you are doing performance evaluation, performance measurement, you should know how it is going to impact different sectors and how they are going to read that. See, if I'm telling you net profit is increased, there are certain category of people who feel happy. There are certain category of people who think that, okay, how about long term? There are certain category of people who think that, okay, what is the benefit for me? So there are different sets of people. So you need to understand that everybody will not look at the same information in the same manner. Okay, that's external considerations that you need to worry about. Stakeholders are there, sir. Any person who is interested in your company is a stakeholder. Your equity shareholders, employees of the company, loan providers, government, community, customers, environmental groups, all these people are different stakeholders for your particular company. So stakeholders will have different objectives. We talk about this more in F9, SBR, APM, SBL. Yeah, in these 4 papers we'll talk about this difference of expectations of the stakeholders, difference in the objectives and expectations of the various stakeholders, how conflict of interest is there in the company, how it should resolve. We'll talk about conflict resolution in APM. Yeah, in APM we'll talk about conflict resolution. In HR topic, I guess, I'm not sure, HR prioritization and all the different techniques will be there. Anyways, we'll talk about it in APM. And then market conditions need to be understood, sir. COVID is the best example. You cannot estimate the same types of activities before COVID and during COVID and after COVID. Obviously, the businesses have taken a huge hit. Similarly, during recession times, during inflation times, you need to understand external environmental conditions also play a very key role on the performance of a company. Similarly, competitors, sir. You also have to consider your competition. If the competition is reducing, automatically your sales will increase. Your market shares will develop. That doesn't mean you are doing great. It just means that your competitors are idiots. As simple as that. Okay, so you need to understand what are the reasons why the performance is getting improved or decreased or whatever it is. Chalo, tomorrow we'll do the building block model and then we will finish the chapter number 10 as well. 10, 11, 13. Chapter 13 also will be finished by tomorrow in the first 15-20 minutes max. Then we'll have 14, 15, 12, 14, 15. 14, 15, 12. Okay, cool. Must see divisional performance measurement. How many pages? 465 to 490. That is 25 pages. Small topic only, nothing much. And then non-profit. Non-profit though will be done in 10 minutes. Non-profit is hardly, it will take 10 minutes for us to explain. Economy, efficiency and effectiveness. That's one discussion. League tables, another discussion done. Okay, look at transfer pricing. Okay, divisional performance, transfer pricing. Okay, what are the topics covered? ROI and ROI is there. Only the basics are there, I guess. Okay, discuss the shortcomings also. Good. Then ROI, RI, transfer pricing using variable cost, full cost, and whatever other cost techniques. How it's going to distort the decisions. Problems. Simple topic only. This is also not going to take much time. Okay, this is easy topic. Not much. ROI versus RI, and then the different transfer pricing techniques. And then non-for-profit organization, VFM, value for money. This is the 3 E's technique, my economy, efficiency, and effectiveness. And then non-financial performance indicators, improving them, short-term versus long-term. There is league tables related discussion. Why didn't they give league tables here? That's all. Chiller topic, 10 minutes mein khatam ho jata. Okay, chalo, we'll see you tomorrow, guys. Bye-bye. Bye, ma. Take care. Have fun.